Welcome back to SR Money News. In the world of high-stakes investment, even the most rigorous analysis can face unexpected turns. We recently discussed Netflix, ticker NFLX, anticipating a strong post-July 16 rally based on our initial read of its strategic shifts. However, the market had a different story, with the stock dipping by roughly 6% instead. This isn't just a misstep, it's a critical inflection point, compelling us to dive deeper, not with regret, but with a renewed institutional lens. Today, we're not just correcting a prediction, we're recalibrating our entire framework for assessing Netflix's intrinsic value in a rapidly evolving market. At its core, Netflix, ticker NFLX, established an unparalleled moat through its early mover advantage in streaming and a data-driven approach to content creation. Its value proposition was simple: a vast, on-demand library for a fixed monthly fee, globally accessible. However, this moat, once an impenetrable fortress, has evolved. The immediate financial implication is that pure subscriber growth in mature markets is nearing saturation, shifting the focus from subscriber acquisition to revenue per user. The forward-looking structural shift is towards a diversified revenue model, moving beyond its original single-stream offering to integrate advertising and potentially expand into interactive entertainment like gaming, fundamentally altering its long-term growth trajectory. Historically, Netflix's growth was synonymous with skyrocketing subscriber numbers. However, the immediate financial implication of market maturation is visible in the deceleration of these headline figures. The focus has shifted from the quantity of subscribers to the quality of revenue, particularly average revenue per user, or ARPU. We're observing a critical margin expansion initiative, a company's effort to grow profits faster than sales through strategic moves like the ad-supported tier and password-sharing crackdown. This isn't just about tweaking prices, it's about optimizing the yield from existing and new users. The forward-looking structural shift points to a more complex revenue stack, where advertising, premium tiers, and international expansion in underpenetrated markets will be crucial levers for future top-line growth and profitability. Management's commentary over the past few quarters has consistently articulated a clear execution strategy: prioritize profitability and free cash flow generation over unbridled subscriber growth. This shift signals a maturing business no longer solely in land-grab mode. The immediate financial implication is a more disciplined approach to capital allocation, how a company invests its money evidenced by tighter content budgeting and a focus on return on investment for new productions. The forward-looking structural shift is a re-anchoring of the investment thesis around sustainable earnings, rather than purely top-line growth, indicating a more traditional, value-oriented operational posture for Netflix, ticker NFLX, aligning with broader market expectations for mature tech companies. The streaming industry has become an intensely competitive battleground. With formidable players like Disney+, ticker DIS, Max from Warner Bros. Discovery, ticker WBD, and Amazon Prime Video, ticker AMZN, the competitive landscape is more fragmented than ever. The immediate financial implication is an increased cost of customer acquisition, the expense to attract new subscribers, and upward pressure on content budgets, as platforms vie for exclusive, high-quality programming. This environment fosters a capital rotation scenario where investors move funds from one sector or asset to another as perceived winners and losers emerge. The forward-looking structural shift is a potential consolidation in the industry or a strategic pivot for many players towards niche content or hybrid models, where Netflix's global scale and established brand remain key differentiators. Beyond competition, Netflix, ticker NFLX, faces inherent risks. The escalating cost of content creation, coupled with the need for a constant stream of fresh, engaging titles to combat churn, represents a significant operational vulnerability. This cost inflation, the rise in production expenses, directly impacts gross margins and requires efficient content ROI. Another risk is market saturation in developed regions, making new subscriber additions progressively harder. The immediate financial implication is the imperative for strict cost controls and a sophisticated content analytics strategy to maximize viewership per dollar spent. The forward-looking structural shift necessitates a global perspective, leveraging international markets for growth while simultaneously optimizing existing mature markets through differentiated offerings. Despite these challenges, Netflix's outlook isn't without significant potential. The rollout of its ad-supported tier represents a powerful new revenue stream diversification, adding new ways to make money that could unlock substantial incremental revenue, particularly in advertising-hungry markets. Furthermore, its nascent gaming initiative and continued international expansion provide additional avenues for growth beyond traditional streaming subscriptions. The immediate financial implication is a potential re-acceleration of revenue growth, albeit with a different mix, and an improved ability to leverage its massive content library across various monetization models. The forward-looking structural shift is a transformation from a pure subscription video-on-demand service into a broader digital entertainment ecosystem, enhancing its long-term earnings visibility. How predictable a company's future profits are. Given the market's initial reaction to our prediction and the deeper analysis, our multi-year thesis on Netflix, ticker NFLX, requires careful reassessment. The question is no longer about short-term stock movements, but about the company's ability to execute on its evolving strategy amidst intense competition and macroeconomic shifts. We're looking for signs of sustained free cash flow generation, the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets and effective content ROI. The immediate financial implication is that valuation metrics need to account for these new revenue streams and the execution risks involved. The forward-looking structural shift is that Netflix is transforming into a more mature, diversified media company, where traditional valuation multiples, rather than purely growth multiples, may become more applicable. This demands ongoing diligence to monitor the success of its strategic pivots. The market's immediate reaction to Netflix's performance serves as a powerful reminder that investment is a dynamic process, demanding constant re-evaluation beyond initial projections. While our initial anticipation faced headwinds, the underlying structural shifts within Netflix, ticker NFLX, and the broader streaming industry provide a richer, more nuanced investment narrative. Our institutional approach at SR Money News emphasizes a continuous, data-driven assessment of corporate strategy, financial health, and industry dynamics. We encourage you to engage with this complex analysis. Stay informed, stay ahead. If you found this deep dive valuable, please subscribe to SR Money News for more institutional-grade market intelligence, hit the like button, and share your thoughts in the comments below. Your informed perspective is what drives our community.